You've probably heard the advice, lock your rate so that you can protect yourself against increases. But what if rates drop after you lock? Well, let's start by talking about what a rate lock is. A rate lock is your lender's promise to hold your rate for a set period of time, whether it be 30 days, 60 days, 90 days. It essentially gives certainty during escrow so your payment doesn't spike unexpectedly. Now, if this part feels confusing or scary, you're not behind. Most first-time homebuyers feel the same way. So in today's episode, we're going to break it down.
So, Jeb, this is one, especially when rates are moving, shooting up, coming down, it is a big topic. It is on everyone's mind. Why? Yep. Why is it on everyone's mind? It is one of those decisions where a small mistake can make a difference of hundreds of dollars in the month, a monthly payment, thousands of dollars over the life of the loan. So the stakes are high when you look at it that way. Now, the reality is rates rarely move that aggressively that you have that type of exposure during, I got a contract I need to close in 30 days, even 45 days. On a refinance, our objective, when things get busy like now, it's hard to hit this, but our objective is to be done in 21 days. And part of that is the shorter the time frame, the less time there is for things to go wrong, for you to worry, concern, all of that. That thought. We generally talk on the show that most clients with a normal risk tolerance, unless they are really, really risk tolerant gambler types, are better off locking once they decide to refinance, or they decide that they find out they're under contract and have a finite closing date. So what are the worries? Well, the worry is, I locked too soon. Well, crap, I locked today and rates go down. And that's what we've seen over the last 4, 5, 6 weeks. What I get is calls every day, Jeb, because I see rates are a new all-time low. Well, whoever's numbers that is, every Thursday, Freddie Mac's primary mortgage market survey comes out. Matt Graham, friend of the show, Mortgage News Daily, they're getting quoted every day by different venues that are trying to get you to click on an ad to get connected with a mortgage lender. So it's never been more prevalent that you're seeing this when rates are going down or up, you're getting hit with it. So the reality is, I got a question from a listener this morning that's buying an investment property. I saw rates got down. Is there any chance we can get a better rate? Well, it's like 0.05% better than when they locked. So we're going to talk about that today. That means that rates are essentially the same. So yes, it is true they are lower, but they're essentially the same. If you're enjoying the show and you like hearing everything you need to know to buy right, borrow smart, and build wealth, make sure you make sure you subscribe, hit the notification bell so you know. We post new episodes here every week. We do a live show on Jeb's channel and here on The Educated Homebuyer every Wednesday, letting you know everything that you need to know to be an educated homebuyer.
Well, let's back up. So the idea of locking your loan is to give yourself some security, right? It's security against the market, right? So going in, going under contract, deciding if you want to refinance. The reason I'm locking my loan at that period of time that we're having the initial conversation, or maybe a day or two later, is so that I protecting myself against volatility in rates going higher, right? But the idea that rates going lower, now I want to take advantage of that. And that's kind of where we're seeing a lot of it at the moment, because rates are moving in an aggressive fashion.
Yep. The whole reason of locking is I'm comfortable with these numbers. I'm ready to do my refinance, or I'm comfortable closing with that monthly payment. So the risk of not locking is the payment becomes different and you either bail out, I don't like it at all, or you're just less comfortable with that monthly payment. So what we're talking about today is what happens if I say, I want that certainty. I want the lender to guarantee me the interest rate, and then they move lower, because there is almost always, I'm sure there's a lender out there that says, no, hard and fast, you locked, this is it. Most all lenders on the planet are going to have a policy where if rates move significantly, not like we just talked about, 0.05% lower in interest rate, the lender's going to expect you to honor the lock just like they would honor it if it went up 0.5%. They're going to honor that lock. There's nowhere where they are going to renege and say, I'm not honoring that lock. So for the most part, they're going to want you to honor it if rates come down. But what we're going through today is the specific situations where you have an option. And Jeb, maybe before what I want everyone to understand is, for you, the borrower, there is such thing as a rate lock. You tell your loan officer, I would like to lock. We're going to close in 12 days. I would like to do a 15-day lock. They go onto the lender's website. They say that we're going to do a 30-year fixed rate conventional loan at 90% loan to value, and we want to lock it at 6.5%. They push the button and it's done. The lender that receives that lock, there's nowhere that they can go and push that same button and lock it. What they know is we got 1,000 of those locks this month. So we know into the secondary markets, we're going to deliver $10 million of loans next month. So they have to buy insurance against rates going higher. So there's a cost to that. So if rates go higher, they are going to deliver you the rate that they offered you because they're insured against it going higher. Now, if rates go lower, people often think, oh, well, now the lender's getting rich because the rate went lower and I agreed to this higher amount. They're not getting rich because they paid for that insurance. So there's a cost to their hedge in the secondary markets to make sure that they are always going to deliver you the best rate. So when it comes down, we have to have a certain level of improvement that they can at least offset the cost of the insurance they bought to keep your rate from going higher.
No, I think that's a good explanation. I mean, again, we all want our cake and want to eat it too. And then we want more cake. And the idea is, hey, listen, I saw interest rates were X today. I want to lock it because I don't want to take a higher rate. But as interest rates start to come down and in somewhat of an aggressive fashion over the last 30 or so days, now I want that better rate. I don't want to just be stuck out here with this higher rate or have to refinance again in a couple of months. I'd like to take advantage of it now. So with that, Josh, let's talk about the whole renegotiation process, float downs. Is there such thing as a free float down? I mean, that sort of thing. These are the questions that we're often get, and I feel like that's the clarity that needs to be provided.
So the lender that is most likely to do a true free float down, no cost to you in any way, shape, or form is a portfolio lender. So you're dealing with a small community bank out in Kentucky. They're going to make that loan with depositors' funds. If rates drop, the rate that they pay out to depositors drops, so their cost of funds is lower, and they're like, we'll let you do that 1 time, 2 times, 50 times during the process. Some of them will say it's a one-time float down, you pick it. Others, it's a one-time float down at docs. If when we're ready to go to docs, rates are lower, we'll float it down. But truly, portfolio lenders are the only ones that are going to do it at no cost. We've talked about, you made a video on your channel, Jeb, about the sales pitch that people have had going around for the last 3 years. If you close your purchase with me, I'll do a free refinance. Free float downs fall into the same category. Anyone who has a free float down priced into their business model, there's a cost of that insurance to lock your rate. So if they're just offering them free, they're saying, okay, 12% of the time we have to do this free float down. So here's the cost of it. And they just worsen their pricing, that in their business model, they have enough profit to cover the cost of that. So you're not paying it directly, but you're paying it indirectly.
Now, I realize a lot of what we're discussing today can be over your head. It can be confusing, as I mentioned earlier in the video. What I would recommend is instead of obsessing about this information, make sure you're working with a professional, somebody that can explain it to you, walk you through the process, make you feel comfortable and confident in your decisions. If you want to work with the team, we help hundreds of people here on YouTube. We'd love to help you too. You can actually get in touch with us using that link in the description.
But let's talk about the most common way that lenders do this. We are approved with about 100 different lenders. 95% of them sell to the secondary market. They're not portfolio lenders, and they all have very, very similar float down policies. And this is what it looks like. And I want to put it in simple terms because some of the things can be wonky inside baseball loan officer terms. But in general terms, if the rate drops 0.1%, that's about the cost of the insurance. So the lender's going to say that's within the range. If rates had gone up 0.5%, we're going to honor that. Rates went down 1/8, we expect you to honor that. So what they want to see is about 0.25% improvement. And the way they define it, rather than saying on the rate sheet, rates are 0.25% lower, they look at the rate sheet on the day that you locked to the current day, and they want to see if it's 100 basis points better. And you might be listening, your eyes glaze over. What in the hell are 100 basis points? 100 basis points is 1 point. So you guys understand what that is. If I'm getting a $400,000 loan and I'm paying 1 point to get the rate, I'm paying 1% of that loan. So they want to see a 100 basis point, a 1 point improvement in that, which generally equates to 0.25%. But in that, they're going to have a charge of 50 basis points, or 0.5 point, which equates to that 0.1%. So let's look at it in super simple terms. If we get a little bit of improvement, enough to trigger the renegotiation, the market improves 102 basis points. Okay, well, now we can roll the rate down and you're going to pay 50 basis points. So it got 1 point better. You pay 0.5 point. You're going to realize about 0.1% improvement in that situation. So the more the market moves, the better this gets for you because the cost of that renegotiation stays consistent. Let's say that the market improves 200 basis points, which in general terms is 2 points and about 0.5% in interest rate. It's still that same 50 basis point or 1/8% cost. So if the market improves that much, 0.5%, you're only going to pay about 1/8%. So you're going to get 3/8 or 75% of that improvement. So the important thing to note is I have borrowers that literally watch this every day and the market moves this much and they go, "Our rates are lower. Can we renegotiate?" You can't because we haven't triggered that level. But number two, you don't want to because there's a cost to it. Let's say you did it and the lender said you can do this 5 times. Every time you're paying 1/8 to get this little tiny improvement. So we want to be watching the trend. Technical analysis is not a crystal ball, but it is similar to counting cards in blackjack. We know when the odds are in our favor. Jeb, your breathing is all over that mic. Like they're gonna lose their mind if it goes out that loud. So that if you want there to be a significant improvement and you want to look at it one time. For us, we're looking at the technicals to say that is very similar to counting cards in blackjack. It doesn't guarantee us that we're going to win, but it lets us know when the odds are in our favor. So right now, I have probably 4 clients that have been locked. 2 of them are purchases that ran long. So they've been in the process much longer than they should have been. And they're asking about this. I also got 2 people on refis and they're asking, and we're close. We're close on both of them, but long way of saying you don't want to jump the gun because this isn't something you can do multiple times. But again, hopefully your process is 21 to 30 days. If you get this kind of a drop during that period, your lender doesn't care. They're not losing money doing it. They're saying, we want to do this because we don't want you to pick up your loan and go somewhere else and close it where we already have our sunk costs, time, effort, and energy into this. So I'm watching it. I want to do it, but I also don't want to say, hey, we just triggered the ability to do it. Because if we think that trend is still moving in our favor, we want it to be able to continue to improve.
Got it. So, and I mean, in layman terms, renegotiations are possible. I guess the question, Josh, how common is this? How common is a true float down where somebody can take advantage of a rate? Because again, rates bounce, they move every single day. Most people don't understand that rates don't stay the same, right? It's even if they look the same on paper, there's still an adjustment to that rate in most cases. With the fee and what the lender sees and the spread and so on and so forth. So, yes, rates have moved down. We're having more conversations about that process of locking. But how common is it? What does the process actually look like of doing it? Are you paying money out of pocket? You mentioned paying something. Is that money coming out of your pocket to pay it?
You need a quick, fairly violent move in the market to trigger this. So does it happen? It doesn't. I believe we had a couple last year when rates improved a ton in the fall in a very short period of time, just like this. This move this year hasn't been quite as violent. But again, those people that were in early, these 2 purchases that have got drug out and delayed, those folks are likely to see that because over the last 6 weeks, we've seen a pretty big improvement. So it is not common for a couple of reasons, because most transactions are 21 to say 45 days. Many people don't lock the day that the transaction opens. I mean, you put a contract together on Friday. I get it on Monday. We send out disclosures. We talk to the borrower. Maybe it's locked on Tuesday. That's a 25-day lock. It has to be renegotiated if you're eligible and you choose to do it about 7 days before closing to be able to issue a new closing disclosure, have that 3-day waiting period, sign docs, and still close on time. So we're really talking about we have to have the market move 0.25% within a 2 to 3 week time frame. And that's not common. Does it happen? It absolutely happens. And again, you should know, me as a loan officer, that's not a cost to me. I go to the lender, I look at their policy. We say, this is what it is. Here, you've triggered the threshold where you are eligible. Do we want to do it now? We have to lock within the next 5 days to get your closing disclosure and loan docs out. So we can do it now or anytime within the next 5 days. Do we want to trigger this, or do we want to see if we get some further improvement over the next few days? It's really not all that different than the lock float decision, other than you can only win. Things can't go against you because you're protected against the worst case of rates going higher.
Now, with that, Josh, is this something that you're watching for your clients as rates move down, and something that is a conversation? Hey, like, rates have moved down significantly. Let's see if there's an opportunity to float down. Or is it something that the borrower has to be paying attention to and reach out and request, if you will?
I will say in the real world, most of the borrowers who are eligible are aware. Like it's not something where I go, hey, look, and we're generally aware, right? Because it has to be someone who's been in process a little bit longer, who locked early in the process, and us knowing right now that over the last 6 weeks, rates are significantly better, and not so much because of the 10-year yield dropping, but because of the mechanics of the way the bond market works. We went from the 5.5% coupon being the predominant pool that loans are going into down to the 5%. All that means to you is that lenders have been offering better pricing at 6.125 than at 6.25, about the same as 6 3/8, and only marginally worse than 6.5. So it makes for when you're presenting options to a borrower, it looks like there was a big violent move down in rates when it really was just a shift to the pools that lenders are delivering their loans to. So it ends up better for the borrowers. It's led to a compression. We talk about spreads, the spreads between mortgage rates and the treasuries. Those spreads are down here recently for no other reason than that shift between pools that the loans are being delivered to. So it's not often, but I generally have a pretty good idea of when it's there. Like I said, I've got about 3 or 4 borrowers that were looking at it, keeping an eye on it. And the other option is for them to know. And most times borrowers know because it's hard. It's hard to have your head in the sand and not know. If you lock an interest rate, you know how it is. We all are worried that our phones are listening to us. Whatever you've been doing in life, it starts delivering to you in your feed on your phone, whether it's Instagram or your Google feed. So people are seeing, they're getting updates, and they'll trigger and say, hey, I saw this, rates are lower. Is it enough for us to do it now? So I've got 2 of them just today that we have to look at, but it is fairly uncommon.
Yeah, and with that, if you're going through the process and you're trying to get pre-approved, maybe you're in the process where wondering if you should lock your rate, talk to a professional. Josh and the team here help a lot of people out, especially on YouTube, on the podcasts. So if you want a professional in your corner, make sure you use that link in the description of the video. So Josh, final words, I guess, here for anybody that's going through this process, like what they should be watching out for. Is there a list they can get on for watching the rate? What's the plan?
What I would say is do not obsess over the rate. Keep an eye on it after you lock because you want to know if you might be eligible for a float down. When you're talking to a lender, you want to know what their float down policy is. You want them to be able to explain it to you in simple terms that you can understand, which shockingly, 80% of loan officers couldn't tell you what it looks like and what it would take to trigger that ability to float down. So know the policy, know what your options are. Ask and have an open dialogue, but let's not obsess over this. I have clients who were pre-approved at 6.75 that are locked at 6.25, and they're going, can I float down? Can I get this lower? Like, by all means, you want everything that's coming to you. I'm not saying don't ask. I'm not saying don't look at it, but we need to realize that you getting a property under contract and at the perfect time and choosing to lock on the absolute lowest day and getting the absolute best interest rate for the 3 to 6 month period when you were in the market to buy a home is almost impossible. So if you want to drive yourself crazy, look at it that way. We have incomplete information. We have to make imperfect decisions because of that. Make the best decision and have peace with it. But know your options. The whole purpose of this episode is to have the conversation and know what your options are.
Yeah, and go with somebody that you trust. If you would like to speak with Josh, the team here, use that link in the description of the video. But until next time, make sure you buy right, borrow smart, and build wealth. Adios.
Amigos.